Friends, thank you for being here today. What if I told you that the price you see on your television screen, the ticker tape scrolling across the bottom of CNBC, is no longer a reflection of value, but a carefully constructed illusion designed to separate you from your wealth? And what if I told you that while Western financial capitals play games with paper contracts, the Eastern Hemisphere has quietly engaged in a hostile takeover of the strategic resources that will define the next century of American life? These are not comfortable questions. They are not the kind of questions you will hear asked on the evening news, nor are they the topics of polite conversation at a Washington cocktail party. But if you're listening to me right now, I suspect you are not interested in polite conversation. You are interested in the truth. You are interested in the security of your retirement, the stability of your nation, and the preservation of your family's legacy in an era of unprecedented economic deception. We stand today at the precipice of a new year, January 2026. If you have been paying attention to the financial press, you have likely been bombarded with a specific narrative. They tell you that the silver squeeze is dead. They point to the red candles on the charts, the sudden drops in price, and they mock the prudent investor who has chosen to hold physical metal. They call you stubborn. They call you archaic. They tell you that the modern world runs on digital promises, not on ancient metal. But today, we are going to dismantle that narrative, not with anger, not with speculation, but with cold, hard data. We are going to look past the waves crashing on the surface and examine the tide. Because beneath our feet, a tectonic shift is occurring. It is a shift from west to east, from paper to physical, and from illusion to reality. This is not a story about a trade. This is a story about a takeover. And to understand the gravity of this moment, we must first look at the invisible war being waged for the very energy that powers our world, specifically regarding the solar chokehold. For the last 5 years, the narrative surrounding silver has been relatively simple. We need more of it for green energy. We have been told that solar panels are the future, and that silver is the conductor that makes that future possible. This is true, but it is a half-truth. The whole truth requires us to ask a follow-up question that the media ignores. Who builds the panels? As of late 2025, we have a definitive answer. The People's Republic of China now controls over 80% of the entire global manufacturing capacity for solar panels. Let us pause and consider the gravity of that number. 80%. This is not a simple market advantage. This is a monopoly. The United States, Europe, and Japan, the engines of the Western world, combined control less than 20%. We have effectively outsourced our energy, independence to a geopolitical rival. But why does this matter for the silver in your safe? It matters because of physics. You cannot build a high-efficiency solar panel without silver paste. It is the essential conductor. It transforms sunlight into the electricity that powers your home, your electric vehicle, and the grid itself. Therefore, if China controls the factories, China controls the demand for silver. We are now receiving intelligence reports, verified by multiple sources on the ground in industrial hubs like Shenzhen and Shanghai, that reveal a disturbing new policy. The Chinese government is no longer content with simply buying silver on the open market. They are weaponizing it. They have quietly implemented the strictest export controls we have ever witnessed. They have erected what we call a resource wall. The message to the West is subtle but devastating. If you want solar panels, you will buy the finished product from us. You will not buy our raw silver to build your own industry. This is a blockade. It effectively traps the physical metal within the borders of the East, creating a bifurcation in the global market. There is now a pool of silver in the East that is being consumed by industry, and a pool of silver in the West that is being traded by speculators. The two are no longer connected by a free flow of goods. And do you think, for one moment, that China will allow the silver they desperately need for their own energy dominance to leave their country just because a bank in New York decides to lower the paper price? Absolutely not. They are happy to let the West suppress the price. In fact, they welcome it. It allows them to drain our vaults at a discount. While this industrial dominance in the East secures the future of energy, the rest of the world is grappling with a different kind of pressure, forcing us to examine the geopolitical instability driving the flight to safety known as the war bid. We must now turn our eyes to the geopolitical stage, because the financial markets do not exist in a vacuum. They are inextricably linked to the stability of the world order, and right now, that order is fraying. In a peaceful world, money chases growth. In a chaotic world, money chases safety. And we are currently seeing a convergence of crises that we have not witnessed since the darkest days of the 1970s. Look at Venezuela. For the last 48 hours, reports have flooded in regarding United States naval assets tightening a blockade around the Venezuelan coast. We are seeing interceptors stopping tankers. We are seeing a level of aggression that implies we are one mistake away from a kinetic conflict. Why? Because Venezuela attempted to sell its oil for UN, bypassing the US dollar. The market interprets this blockade not merely as economic policy, but as a flashpoint for war. Every time a destroyer halts a tanker in the Caribbean, The risk premium on every commodity in the world spikes. But it is not just South America. Look at Africa. Look at Nigeria, the largest oil producer on the continent. We have confirmed reports of massive coordinated strikes across their oil fields. This has taken Nigerian light sweet crude offline at the exact moment Venezuelan heavy crude is being blockaded. This is an energy shock, and history teaches us one undeniable lesson. When energy prices rise, silver prices rise. The correlation is direct. Energy is the primary input cost of mining. You cannot extract ore from the ground without diesel fuel for the excavators. You cannot refine that ore without massive amounts of electricity. If the cost of energy doubles, the cost of producing an ounce of silver must rise, or the mines will simply shut down. But there is a deeper psychological force at play here. Energy shocks create inflation. They destroy the purchasing power of the dollar. When you pay more at the pump, you have less to save. The dollar in your pocket buys less today than it did yesterday. Smart money, the sovereign wealth funds, the family offices, the endowments, they see this. They see the smoke rising from the oil fields of Nigeria. They see the naval destroyers off the coast of Caracas, and they are terrified. They know that in a world on fire, a piece of paper that promises to pay you dollars is a liability. It is a claim on a government that is $35 trillion in debt. So where do they go? They run to the fire exit, and that fire exit is painted silver. This is the fear trade. The mainstream media tries to tell you that silver is dropping because the economy is strong. That is a lie. The smart money is buying because they are hedging against disaster. This is why the price refuses to stay down. Have you noticed? Every time the banks smash the price to $70, it bounces right back up. It is like trying to hold a beach ball underwater. That buoyancy is the war bid. It is the refusal of the market to accept the paper valuation. Now, you might be listening to this and thinking that it sounds logical, yet you demand hard evidence. To find that proof, we must turn our attention to the cold, hard data that the banks simply cannot hide. We must look at the numbers that appear when the algorithms glitch. We must look at the Shanghai premium. In a perfectly efficient global market, an ounce of silver should cost the same in New York, London, and Shanghai, minus the cost of shipping. If silver is $71 in New York, it should be roughly $71.50 in Shanghai. But that is not what we are seeing today. Right now, as I speak to you, the price of physical silver on the Shanghai Gold Exchange is trading roughly 7 higher than the price on the COMEX in New York. $7. To the layman, this might just sound like a number. To a market professional, this is an impossibility. It is a screaming siren. In a normal market, arbitrage traders, people who buy low and sell high for a living, would buy every ounce available in New York for $71, fly it to Shanghai, and sell it for $78. They would pocket the difference, and within hours, the gap would close. But the gap is not closing. It is widening. Why? There is only one explanation. The metal cannot leave New York fast enough. Or, more frighteningly, the metal simply isn't there in the quantities they claim. This spread is the smoke alarm. When the kitchen is on fire, the smoke alarm goes off. The Shanghai premium is telling us that the Western vaults are being drained. It tells us that the real price of silver, the price paid by the people who actually use it to build things, is nearly 10% higher than the fake price shown on your trading app. The Chinese industrial complex is happy to pay this premium. They know the paper price is a lie. They are draining the West of its real wealth while our own financial institutions play games with paper derivatives. The West is putting its family heirlooms on a clearance sale, and the East is buying them all. However, this overwhelming physical demand raises an obvious question. If the fundamentals are so strong, why did we see the price drop last week? The answer lies in the darkest chapter of this story, involving the manipulation of market mechanics, known as the margin nuke. We have to talk about the manipulation of the market mechanics themselves. The COMEX futures market is a casino built on leverage. When a trader buys a silver contract, they do not pay the full value of the metal. But then, in the dead of night, the exchange changed the rules. The CME group quietly announced that they were raising the initial margin requirement from roughly $21,000 to $25,000 per contract. To the uninitiated, a $4,000 increase sounds like technical jargon. Who cares, you might ask? It's just a small hike. Friends, this was not a small hike. This was a targeted assassination of the retail trader. Imagine you have a mortgage. Imagine the bank calls you on a Sunday evening and says, "We have decided, retroactively, that your down payment was too low. You must wire us another $40,000 by Monday morning, or we are taking your house." That is exactly what happened to thousands of traders. The small investor, the patriot who bet on silver using leverage, suddenly found himself in a deficit. He received the dreaded margin call. Wire us $4,000 per contract immediately, or we liquidate you. Most people do not have thousands of dollars sitting idle in a brokerage account. They are fully invested. So what were they forced to do? They were forced to sell. They sold not because they wanted to. They sold not because they stopped believing in silver. They sold because the rules were changed to force them out. When thousands of traders are forced to sell at the same time, the price crashes. And when the price crashes, it triggers more margin calls for the people below them. It is a man-made avalanche, a feedback loop of destruction. And do not believe for a second that this was an accident. The exchange usually raises margins when volatility is extreme, when the price is moving wildly up and down. But in late December, the price was quiet. It was consolidating. There was no risk management reason to hike margins. The only reason to do it was strategic. They did it because they knew what was coming in January. They knew about the China export ban. They knew about the Venezuela tensions. They knew that if they didn't flush out the longs now, the price would explode upward and bankrupt the banks that are short. This was a preemptive strike. They shook the tree to make the fruit fall into their baskets. Understanding this manipulation brings us to the specific strategy being deployed for the opening week of 2026, a tactic we have identified as the Algo flush. We must understand who is on the other side of this trade. We are up against commercial banks, giants like JP Morgan and the swap dealers. These entities are currently net short by a historic margin. They have bet billions of dollars that the price of silver will go down. But the price is in the 70s. Their bets are underwater. They are bleeding capital every day the price stays high. They are trapped. So they have devised a plan to escape. And we have seen the blueprint. Just 48 hours ago, a research note from Morgan Stanley began circulating among high net worth clients. The headline was innocuous, something along the lines of "Commodities rally overextended, time to exit." They are advising their clients to sell. Now, you need to learn to speak, banker. When a major investment bank tells the retail public to sell, it does not mean the asset is bad. It means they need to buy. Markets are a zero-sum game. For every seller, there is a buyer. If JP Morgan needs to buy 50 million ounces of silver to cover their short position and exit the trap, they cannot just walk into the market and buy it. If they did, their massive order would push the price to $100 instantly, and they would destroy themselves. They need liquidity. They need a massive crowd of people selling so they can buy without moving the price. So they create the fear, they raise the margins, the stick, and they publish the scary report, the narrative. They want you to panic. They want you to sell your contract at $72 so they can buy it. They are trying to engineer a bailout for themselves, funded by your losses. We can see their targets on the chart. We call this the kill zone. It sits between $70 and $72. The banks know that thousands of retail traders have placed stop-loss orders just below these levels. Their supercomputers, the algorithms, will try to push the price down just enough to trigger those stops. Once the stops are triggered, the computer sells automatically. The price drops further. And who is standing at the bottom with the bucket? The banks. They catch your selling, they cover their shorts, they escape. But there's a flaw in their plan, a fatal flaw. In the past, this trick always worked because the only people buying silver were speculators. When the price dropped, the speculators ran away. But today, the buyer is not a speculator. The buyer is China. The buyer is Samsung. The buyer is the strategic reserve of nations. These buyers do not use stop losses. If the banks smash the price to $68, the Chinese industrial buyers will not panic. They will say, "Thank you for the discount," and they will buy more. This creates a concrete floor under the market. We are watching a collision between the Western flush and the Eastern bid. The banks are trying to push the price down to save themselves, but the physical reality of the market is pushing the price up. There is a specific number you need to watch. The line in the sand, that number is $82.67. This is the breakout zone. The banks have defended this level for 3 weeks. They have built a fortress of sell orders here because they know the truth. If the price closes above $82.67, the technical trend changes. The massive hedge funds, the trend followers who control trillions of dollars, will see that breakout. Their computers will switch from neutral to max long. If that happens, the buying volume will be like a tsunami. It will overwhelm the bank's suppression tactics. The path from $82 to $100 is a vacuum. There is almost zero resistance. We could see a move to triple digits in a matter of 48 hours. This is why the fight is so vicious right now. Ultimately, understanding these short-term tactics forces us to confront the most critical question for every American taxpayer and retiree: the difference between cash settlement and true power. It means we are approaching a moment of truth regarding the nature of ownership. For 50 years, we have lived in a world of paper promises. You buy a stock, you get a digital entry. You buy a bond, you get a statement. You buy a silver ETF, you get a claim check. But in a crisis, promises are broken. I need to warn you about a term you will likely hear in the coming months: cash settlement. If this squeeze goes vertical, if the price rockets to $100 or $200 because of the shortage, do you think the banks are going to deliver the metal to you? Do you think they are going to hand over the strategic assets that are essential for national security and industrial survival? No, they will invoke the force majeure clause, They will trigger the cash settlement rule. They will close your position and put dollars in your account. They will say, here's your $72. The market is closed. Have a nice day. You will be left holding fiat currency, dollars that are rapidly losing value due to the very inflation driving the crisis, while the real asset, the physical silver, becomes unobtainable at any price. You will be rich in digits, but poor in reality. Cash settlement is the ultimate default. It is the bank admitting they have lost the game, but refusing to pay the winner in the currency that matters. This is why physical ownership is not just a preference. It is a necessity. If you hold the coin in your hand or the bar in your private vault, you hold the power. They cannot cash settle a physical bar. They cannot margin call a physical ounce. You have removed yourself from their casino. You are no longer betting on the game, you own the chips. We are witnessing the pivot of pricing power. For half a century, New York and London dictated the value of silver to the world. If London said silver was $5, then it was $5 in Shanghai. That era is over. When Shanghai bids $80 and New York bids $72, China is the captain. The East is saying your paper price is irrelevant. We have the metal. We have the factories. We set the floor. This is a transfer of wealth and a transfer of sovereignty. And if you are holding paper, you are on the losing side of that transfer. If you are holding metal, you are the lifeboat. But beyond the immediate transfer of wealth, we must confront the long-term strategic reality facing our nation, a reality that every head of household must consider independent of the daily fluctuations of the market. We must pause and ask what this specific financial event signals for the broader horizon of American prosperity. When we speak of the silver takeover, we are not merely discussing a commodity, we are discussing the erosion of the economic bedrock that has supported the American middle class for generations. The principles of fiscal responsibility, the idea that you cannot spend more than you earn, and that a currency must be backed by productive capacity rather than debt, have been systematically abandoned in Washington, but they have not been abandoned by the laws of economics. We are currently living through the consequences of a $35 trillion debt experiment. For years, we were told that deficits don't matter, that we could print our way to prosperity, and that the dollar would remain king regardless of how many we printed. The events unfolding in Shanghai and Venezuela are the direct refutation of that arrogance. The world is voting, not with ballots, but with bullion. They are rejecting the debt-based model that has allowed us to export our inflation to the rest of the globe. And as this tide turns, the cost of that profligacy will return home to roost, at the gas pump, at the grocery store, and in the diminished value of your savings account. This is where the concept of economic resilience becomes personal. For the average American family, resilience is no longer about trusting that a pension fund will remain solvent or that Social Security will keep pace with real inflation. Resilience is about independence. It is about decoupling your family's future from the fragility of a system that is being challenged by foreign adversaries. When you hold physical silver, you are not just making a speculative bet. You are building a personal fortress. You are securing a form of wealth that does not require a signature from a banker or a vote from a politician to retain its value. We must also consider the strategic vulnerability of our nation. If we allow the East to control the pricing and supply of the strategic metals required for the 21st century economy, we are surrendering our industrial sovereignty. We become a client state, dependent on the goodwill of our rivals for the very technologies that power our lives. But this is not a fait accompli. The American spirit has always been defined by self-reliance and the ability to adapt. By taking personal responsibility for your financial destiny, by moving out of paper and into real assets, you are doing more than protecting yourself. You are sending a signal. You are voting for sound money. You are rejecting the culture of debt and leverage that has weakened our republic. American prosperity was never built on financial engineering. It was built on production, savings, and tangible value. The return to silver is, in many ways, a return to those foundational values. It is a rejection of the something-for-nothing mentality that has plagued our capital markets. By securing your own financial perimeter, you are contributing to a form of national resilience that no government program can provide. Strong families make a strong nation. And families that own real assets are families that cannot be easily manipulated, coerced, or impoverished by the shifting winds of geopolitics. This is your duty, not just as an investor, but as a guardian of the American way of life. I would love to hear your thoughts on this matter. Do you believe these economic shifts will ultimately strengthen or weaken the American middle class over the next decade? Let us discuss this in the comments below, because your perspective matters. As we prepare to face the volatility of the days ahead, I want to leave you with a final perspective on what this all means for your future. Friends, the days ahead will be volatile. You will see price swings that defy logic. You will see headlines designed to make you despair. You will see the Algo flush try to shake you out one last time. But I want you to remember the data we discussed today. We must remember the 80% solar monopoly, the $7 Shanghai premium, the desperation of the $25,000 margin hike. and the fact that the banks are advising you to sell because they are desperate to buy. Do not let them steal your position. Do not let them scare you out of the greatest wealth transfer in history. The destination is not $75. It isn't even $82.67. The destination is a complete repricing of silver to reflect its true scarcity in a world that cannot function without it. The system is breaking, but it is breaking in a way that favors the prudent. It favors the patient. It favors those who understand that in the end, he who holds the gold and the silver makes the rules. Stand fast, ignore the noise, watch the spread. Thank you for your time. If you found value in this analysis, I invite you to like this video and subscribe to our channel to join a growing community of informed citizens. God bless.